Cloud. Okay, so this is now being recorded. So without further ado, I'm going to pass this on to Tzvi to take it away. So Tzvi, thank you very much. Welcome, and please begin.
Thank you, Sure. It's a pleasure to be here. Thank you for inviting me. I hope it will be productive, and I hope I'll help you guys out a little bit. Can you see my screen?
Yes. Yes.
Okay, great. Okay, so let's dive right in. This is the Corporate Transparency Act. It was passed in 2020. It went into effect January 1st, 2024. And during the course of this presentation, we'll see exactly what that entails. So today's agenda is to explain to you, first of all, the purpose of the Corporate Transparency Act. It's important to know because once there's context to things, a lot of the parts of the puzzle fit in. We're going to talk about which businesses need to file and which businesses are exempt. We'll talk about who needs to be listed. This is not about listing companies. It's about listing people behind companies. So we'll discuss which people need to be listed for each company. We'll discuss what information is required and what the deadlines are. And then at the end, we'll talk about federal court decisions and the future of the Corporate Transparency Act, because there has been some challenges, but a lot of that has actually subsided with a recent decision. But we'll just cover that very briefly so you understand where we're at. Okay, a little background. First of all, we'll start with the terminology because there's, like everything else, there's always a lot of acronyms thrown around. So the CTA is the Corporate Transparency Act. It was an act passed, like I said, in 2020 by the government in order that there should be transparency in all corporations. Until then, or until now, you can hide behind LLCs, and we'll talk about what the problem is and how people are able to do that. So the Corporate Transparency Act said there's no more hiding, and therefore you have to file. The actual filing itself is called the Beneficial Ownership Information Report, either called the BOI or the BOIR, depending on who you are. We're early in the game, so everybody's got a different name for it. And the people that you file with, sometimes we say the IRS, but it's not actually the IRS. It's worse than the IRS. It's FinCEN, which stands for the Financial Crimes Enforcement Network. You may know about them from some other rulings, like if you're overseas and you have more than $10,000 in a foreign bank account, you have to file a FUBAR. That's also a FinCEN ruling. Basically, they are after the bad guys in the monetary world. Okay, so what is the CTA all about? The CTA is intended to help prevent money laundering, terrorist financing, tax fraud through all kinds of shell companies. I don't know if this is actually true, but it makes sense, and it will give you some context. Part of the problem of 9/11 that they didn't catch it was because the way they financed it, they did it through shell companies. Nobody was able to really track the money flow. Had they been able to track the money flow, they would have been able to very quickly, at least afterwards, investigate and track it back to its roots. But since they weren't able to, it was very hard to figure out who was behind all this. So because of that and a whole bunch of other reasons, like we just said, with all kinds of terrorist financing and tax fraud, the government said there's no more anonymous LLCs. And what that means is like this. The states, when it comes to LLCs, what an LLC is run by the state. It's permission from the state to do business in the state and to use its court system. So if you want to do business in a state, you need to register with the state and you need to register your LLC. If you want to have limited liability and you want to use the courts, that's what you have to do. But the states don't really care about money laundering and tax fraud and all these things. What they want is money. They just want to earn money. So you file your LLC, you pay them money, they're very happy. Now, each state has their own agenda. So a state like New York, everybody does business in New York. They don't have to give you any perks for an LLC in order for you to file there. You're going to file there because you have to, because you're doing business over there. But a state like Wyoming has no business, has no internal intrinsic business in Wyoming. But what they've done is they've carved out a nice little business called the LLC business. So they make it very attractive to file in Wyoming, to open up an LLC in Wyoming. And I don't want to get too much into detail, but you can't just open up in any state you want. But they've done it for online businesses and all the, they figured out there's a whole bunch of businesses that don't need a specific state. And all those businesses file in Wyoming because it's cheap. They give you great asset protection. They give you anonymity and they give you all kinds of things. And therefore, That's their end game, because they're just collecting $100 per formed LLC and then $50 a year for every LLC, and they're very happy. But the federal government's not so happy with the situation because, as we said, the federal government is responsible for the safety. They're responsible. The IRS wants their taxes. So they don't like this game of anonymous LLCs. Now, because there are states like Wyoming that have anonymous LLCs, and if you can follow this, one LLC is allowed to own another LLC. So if you open up an LLC, let's say in Nebraska, you can't be anonymous. You have to say who you are. But you can still be anonymous because what you do is you make the owner of the Nebraska LLC your Wyoming LLC. So your Nebraska LLC is not anonymous because it's listed an owner. The owner is Wyoming LLC. But the problem is, after you get to you track it back to the Wyoming LLC, that's where the government runs into a dead end because the Wyoming LLC is anonymous. So you effectively created an anonymous LLC in a non-anonymous state. So these are the games that the federal government is trying to stop. And the federal government has basically said, we don't care what state you're in. We don't care what the state requirements are. Anybody who forms an LLC with the state, or almost everybody, we'll see, has to give us the name and the information of all the people who are behind the LLC. So that's basically the Corporate Transparency Act in a nutshell. Okay, so now the question is, which businesses need to file beneficial ownership and which are exempt? So what we call it is reporting companies. Reporting companies have to report to the federal government. They're beneficial owners. And the official definition of a reporting company is any entity that's created by filing with the state. So an LLC, for example, you file with the state. If you have a sole proprietorship, you don't file it with the state, so you don't have to report to the federal government. Okay, so let's just go through some of the yeses and nos. Any corporation is filed with the state. It's a reporting company, has to file a beneficial ownership information report. An LLC, LPs, any foreign company that's registered in the United States. And the ones that don't have to report are a sole proprietorship, because sole proprietorship, you don't have to, you want to open up a business, you could just open up a business and you don't have to tell anybody about it. You do at the end of the year, you have to report your profits to the government, but in terms of filing with the state, you don't have to do that, or just a general partnership that's not an LLC or an LP. So those would not have to report to FinCEN. They wouldn't have to file a BOI. And most trusts, as people don't notice, but trusts are not filed with the state. Trust is a private document that sits in your drawer that your lawyer drafts up. A trust does not have to file a BOI because it's not registered with any state. Now, there are 23 exemptions of companies that don't have to file the BOI. But the truth is, there are really no companies that don't have to file a BOI. The reason why these 23 exemptions, if you look at them, they're all different kinds of companies that are already filing with either the Securities Exchange Act, the Investment Company Act. The bottom line is that these are companies that the government knows more information than they're asking for with the BOI. They already know everything about these companies because of the licenses and all the licensing requirements. So they don't need this little BOI report, which you'll see contains very little information. They know far more than the BOI is going to tell them. But there are, there's officially 23 exempt entities, and it's good to, just go through the list quickly. Securities reporters, brokers, dealers, accountants, all kind of public utilities. The two that we're going to focus on that are most relevant for us are number 21, which is a large operating company, and number 23, which is an inactive entity. Okay, a lot of people have old entities that they formed. They're just sitting there. They never used it, or they haven't used it for years, and they want to know if they have to file their BOI. So these are the two classes that we're going to talk about now. Let's start with inactive entities.
I didn't see nonprofit on there. Nonprofits have nothing to do with this, right?
Nonprofit entities are exempt. Nonprofit entities have a lot of filing to do, and they give a lot of information. So you would see tax exempt entities. That would be number 19.
Okay, got it. Yeah.
Okay, an inactive entity. A lot of people think that their entities are inactive because they don't actually use them, but they are exempt. But your definition of inactive entity is not the government's definition of inactive entity. So let's dive into what the government calls an inactive entity. It must meet all 6 of these conditions, not 1 of 6, not 2 of 6, all 6. And we'll start with the first one that will knock most of them out right away. If the company was in existence after January 1st, 2020, it's not called inactive. You could have formed it in 1995 and dissolved it January 1st, 2020, and never used it ever since the day it was formed. The company is called an active entity. It doesn't exist anymore today, but you need actually, no, if it still exists, if it existed January 1st, 2024, we'll get into that. But it's called an active entity if it exists, if it was formed before, if it was in existence after, if it was, sorry, now I'm getting confused. If the company was in existence before January 1st, 2020, then it is an inactive entity. If it was formed after January 1st, 2020, it's not called an inactive entity and needs to file. The entity is not engaged in active business. The entity is not owned by a foreign person. So if it qualifies as an inactive entity, let's say it was formed in 1990 and wasn't used, then as long as it's a foreign person that's behind it, then it has to file. The entity hasn't changed ownership in the preceding 12 months, and it hasn't passed through any funds, at least $1,000 in the past 12 months, and it doesn't have any assets today. Okay, so if you meet all 6 criteria, you're an inactive entity. Most entities do not meet that. Okay, large operating company. So the reason why a large operating company is exempt is because, again, it's big, it's on the radar screen, it's not fraud, it's got all kinds of reporting to do because of its employees and because of its gross sales. So the government's very aware of it, and you're not going to be able to hide anything in it. So the 3 qualifications of a large operating company are 20 full-time employees, $5 million in gross sales, and a physical office within the United States. So now the question arises, if you have a conglomerate, you have, let's say, a holding company and then 2 subsidiaries. So the question is, how do we count the employees and how do we count the gross sales? So when it comes to gross sales, you can add up the whole group's gross sales. Let's say each company is doing $2 million in sales, comes out to a total of $6 million. Then each one of those LLCs are considered passing the threshold of $5 million. And based on that, they qualify as a large operating company if they each have 20 full-time employees. Now, the 20 full-time employees have to be in each entity. So let's say only one of the subsidiaries had 20 full-time employees. That means even though they all qualify for $5 million in gross sales, only the subsidiary that actually has 20 full-time employees is going to be exempt because the other ones don't have 20 full-time employees and they can't consolidate the employees across the group. Okay, is that clear? Okay. Who needs to be reported in the BOI? So the reporting people are anybody who's a beneficial owner, which means that they have 25% interest in the company or more, or they have substantial control over the entity. That means that they don't have to own anything from the entity, but they are decision makers. They have substantial control. I'm going to dive a little bit deeper into each one of these in different slides. And the third one is somebody called a company applicant, and it's the one who formed the LLC in the first place. So beneficial owner.
Tzvi, before we go further, someone just posted a question regarding large operating companies. Does this apply for an LLC that does over 5 million in gross?
Yes. No, gross, that's called a large operating company if it has $5 million, if it also has 20 employees and it has a office in the United States.
Okay.
Okay, so to qualify, to be called a 25% owner that needs to be listed as a beneficial owner, you need to have either 25% of total voting rights. So if you're, let's say, a GP and you have a small equity stake, but you control the company and you have more than 25% voting rights, you are considered a 25% beneficial owner and you need a file. Or if you have a 25% total ownership interest, that means your entire stake is more than 25% in the company, then you have to be listed. If you can't determine, let's say there's different classes of shares and it becomes a nightmare to calculate how much you own, because you may own some of Class A, and we don't really know how much Class A is worth in the total picture. Whatever it is, if you own 25% of any class of shares, then you're considered a beneficial owner. I mean, you'll see where the government is going with this. The government is making this an extremely inclusive law. They're trying any doubt or any way they can call you a beneficial owner or any way they can call you a reporting company, they will. So basically, all the attorneys are telling anybody, if there's any gray area, you better file, because the government purposely left it vague in order to make sure that all of you file, whether you need to, whether technically, you know, if they really drill down, you wouldn't have to, or you would, you better file. So and you'll see the penalties are pretty stiff. So they're really going all out on this, which was actually one of the claims in court, that a lot of this is vague. So how can they actually, this law doesn't work? But we'll see that that didn't work so well anyway. So what does it mean, ownership interest? It could be a stock or equity interest. It could be voting rights. It could be convertible shares. It could be a put call option on 25% of the entity. Or it could be, like we said, 25% of any single class of shares, even if there are multiple classes. Okay, so basically, if you own 25% of anything, you need to be listed as a beneficial owner. Okay, who has substantial control? So anybody who's a senior officer, CFO, CTO, CEO, of course, and the general counsel, they're considered substantial control. They're decision makers, and they need to be listed on the BOI. Now, if you have somebody who has authority to appoint or remove officers or a majority of the directors, they're considered a decision maker, and they need to be listed. And again, another catch-all phrase by the government, just, you know, they don't know what it means, but who knows? Maybe we'll catch a few people this way. Anybody who's an important decision maker. What that means, nobody knows. And then, of course, again, any other form of substantial control. So, like I said, this is beyond overly inclusive, but that's just the way it is. That's what we're dealing with.
So someone posted a question, which is common. Some people, they create a business and they make their wife a partner in the business. So how does that work?
So if they're 50% partners, then she has she's a substantial owner, and she would need a file as well.
But it's not, it's just one filing, and just you're listing them all in one filing.
Right. She needs to be listed. I'll tell you something even more than that. If you're in a community property state, so that means that everything you own is shared by you and your wife. So let's say you are in that kind of state. I think Texas is a state like that, and you have a 25% stake in the LLC. What happens? Who files? Is it you, your wife? None of you, because since your wife owns half of what you own, you each have only 12.5%. So all the lawyers out there will tell you that you both have to file, because community property means that even though you only own 25%, it means you own 25% and she owns 25%. Of course, you only own 25% together, but the government expects both of you to file.
Okay, there was one other question that just came up here. If someone gets paid 25% of the company's profits, but is just an employee, does he qualify for BOI?
Great question. Okay, so we'll get to that in a minute. Employees are exempt. It doesn't make a difference how much they're paid. If they're not substantial decision makers, they can take all the profit home, you know, because they got a fantastic salary. It doesn't make a difference. It has nothing to do with salary. An employee is exempt. Okay.
Okay.
Company applicants. Company applicant is the person who forms the entity or the person who directs the formation. So just to explain you what that means, let's say you decide to form an entity. You have an LLC, you form the entity, and you call up a filings company and you ask them to form the entity for you. So you're a company applicant because you directed the formation. You called up the filings company and asked them to form the entity. And a person from the filings company is the one who's forming the entity directly, and they would have to also be listed as a company applicant. Okay? So that means that one of the reasons that many lawyers have stopped forming entities for their clients is they don't want to be anywhere near this BOI. It's not worth it for them to be listed on the BOI. They prefer just to forgo a couple of $100 and let somebody else do it. It's not something that they want to get involved with. Now, it's important to know that any company that was formed before this year, before January 1st, they're exempt from reporting company applicants. And the reason is simple. There was no law. And for example, let's take the lawyers. They all formed entities for their clients without knowing that there's a law that they're one day going to have to be listed on the BOI. So because of that, since they weren't warned, so the company applicant does not have to be listed on all old entities, but on new entities, they have to be listed.
Someone just asked if an LLC was closed before the filing deadline. Is that?
Yeah, that's a really great question. So if it was, so let's take an example. A guy formed a LLC on in December 25th, 2023. When's his deadline? His deadline to file would be December 30th, 2024. He has till the end of this year to, we'll talk about deadline soon, but he has till the end of the year to file. If that company saw the light of day, if that company was around on January 1st, and right after the strike of midnight, after the apple fell, they dissolved the entity, that company, come December 31st, and he forgot a long time ago about that LLC, still needs to file, because it was responsible to file as soon as January 1st came, even though it didn't reach the deadline yet, but since it was responsible to file, it needs to file. So you would have to file for that dissolved entity. Crazy as it sounds.
Someone just asked a rather sophisticated question. How do you report an LLC venture fund that owns more than 25% of your C Corp? Do you need to know the individuals who own more than 25% of that LLC, or just the name of that LLC as an owner for the C Corp?
Okay, that's exactly what we're going to talk about now, and then we'll have a little challenge for you guys. See if you can make sense out of all this. Let's take a typical example. You have individual A and individual B. Individual A is the manager. Individual C owns nothing from the LLC, but he's a manager. So who has to report? Well, each A and B have to report because they own 50%, so that's more than the 25%. A would have to report even if he didn't own 50% because he's a manager. And C also has to report because he's a manager, even though he doesn't own. So all three of these people have to be listed on the BOI. Okay, that's a simple case. Now, getting to your sophisticated question. The LLCs as beneficiary owners. Let's say an LLC owns a LLC. An LLC owns 25% of another LLC. So when the child LLC files its BOI, who's listed? Is the LLC listed or are people listed? So the answer is that people are listed. LLCs are not beneficiary owners. Only people are, not companies. And let's look what that means. Okay, here we have a quite complex org chart for this purpose, and let's work through it. Okay, the question is who has to file over here? So you have a reporting company. Right now, understand, we're going to have to, the reporting company is going to have to file its own its own BOI, company Y will, and company Z, right? All these companies are going to have to file. But let's look, but each one we have to look at on its own basis and figure out who the beneficial owners are of that reporting company. Okay, so you have company Y, which owns 50%, and company Z owns 50%. Now, individual A owns 30% of the stock of company Y, right? And that leaves him with less than 25% ownership in the reporting company, because 30% of 50% is less than 25%. So technically, he doesn't own 25%. He would not need to be listed. But if you see over here, he's actually the CFO. And as CFO, he would need to be listed on the reporting company's BOI. Okay, let's take individual B. He is not a CFO. He is not a manager, not a decision maker, but he owns 70% of the stock of company Y, which means that he owns more than 25% of the reporting company, and he would need to be listed. Individual A, he's got a 25% share of company Z, which has 50% of the reporting company, which means he falls far below the threshold. But again, this is the same individual A as the first individual A. So if you combine his two holdings between company Y and company Z, turns out that he does own 25% of the reporting company. So since we're looking at people, we don't really care how they own their 25% of the reporting company. It turns out that he owns 25% of the reporting company, and he would need to be listed even if he wasn't the CFO. Okay, then we have individual C. He only owns 25% of company Z, so he doesn't own 25% of the reporting company, but he's the CEO and president, so he would need to be listed. Individual D and E don't need to be listed because they don't own 25% of the reporting company and they're not substantial. They're not decision makers. Individual F would need to be listed even though he owns nothing because he is an important decision maker through board representation. So it turns out in this one, you have individual A, B, C, and F who would need to be listed. Okay, in this example, you see the answer on the bottom, A, B, C, and F. Okay. Trusts. What about a trust? Can a trust be a beneficial owner? So a trust itself is not a reporting company. You don't have to report who owns the trust. But let's say a trust.
So, sorry, Tzvi, before we continue with trust, someone just posted a question. What about a guardian who controls ownership of an LLC?
Very good. We'll get to that also. Okay. He's going to be exempt. Okay. A trust as a beneficial owner. A trust. So when it comes to a trust, we look at the trust and we say, okay, does the trust have substantial control or does it own 25%? And if it does, then we need to find somebody, or we have to see if there is somebody who would need to be listed that's part of the trust. So if the beneficial owner of an LLC that's owned by a trust would be either a trustee, because a trustee that has the authority to dispose of the trust assets controls the reporting company. It can be a beneficiary, but the beneficiary would have to be the only recipient. He would have to be a sole beneficiary, and he would have to have a right to demand distribution. So let's say you have a trust that's 100% owned by an LLC. Funnily enough, if there were two beneficiaries, which means each one of them are 50% owners technically of the LLC, they would not have to file because they would not have to be listed because they're not sole permissible recipients. Okay, this is, there's a lot of this stuff that's counterintuitive, doesn't make sense, and the trust is certainly one of them. If you have a grantor trust, where a revocable trust, where the grantor can revoke it at any time, he is also considered a beneficial owner, and he would have to be listed as well. And then you have three people who control the trust. It would be a trust protector, a distribution advisor, or investment advisor. Since they're decision makers in the trust, then they're decision makers in the LLC, and therefore they would have to be listed as one of the beneficial owners of the LLC. Okay, now we're going to go into people that are exempt. There's 5 exemptions. The first
one. 1 second. Let me ask you just how much longer of how much more content do you have to cover?
Good question. I don't know. 15 minutes, 10 minutes. You want me to make it quick? You want me to?
Well, I would say the following, just because some of this is very technical and it applies to very specific, subset. Can we, on a practical level, in other words, if you are someone who's responsible for filing, what are the steps to filing? Like how much does it cost? Well, how's that? Let's talk about that, and then you could address all the more technical. Yeah.
Very good. Okay, so a reporting company. What do you have to file? A reporting company needs to file its legal name, any DBAs, current street address, jurisdiction of formation, and the EIN number. That's what the filing has. Reporting company information, and that's that. The beneficial owner, we need his legal name, date of birth, residential address, personal ID, which is a passport or driver's license number, and a copy of the ID. Now, it's important to know that your residential address can change. Your driver's license can change. You can add a DBA. Anything that changes, you need to update your BOI. Even though it's a one-time filing, you never have to file again unless something changes. Okay? Exempt entities don't report the names of the individuals. They just, let's say the LLC is a 50% owner, but it's a nonprofit. So you don't have to report the people who own that nonprofit don't have to report, even though they own more than 25% of the reporting company. You just say that it's owned by an LLC and the LLC is exempt, and that's it. Okay, so like, for example, over here, if this was an exempt entity, we wouldn't have to report A and B. Okay, let's talk about the filing deadlines. This is important. If the LLC was in existence before 2024, then your deadline to file is at the end of the year. By January 1st, 2025, it needs to be filed. If you formed it in 2024, you have 90 days from the date of formation to file before you are over the deadline. 2025, you have going further next year. If you form an LLC, you're going to have only 30 days. Really, it would have been 30 days this year too, but the government was a little bit disorganized, so they gave a little extra time just so things don't get out of hand. Okay.
Now that this is something you file together with your tax return, this is just a one-time, you log on online, there's a place to go online, you need an accountant to do this? Like, what are the...
So you can actually go, FinCEN has a database, and you can, it's not connected, not to tax returns, not to formations. You can go online and do it yourself. It's a little bit complicated, and part of the problem is that the government has no record. You can't log into a portal to see if you have done it. There's no record except for the email that they send you that says that you've done it. So a lot of people file it, like companies, through hours. What we do when they form the LLC is we just file it for them, and then we have it in our portal, and if they have to update it, we let them know. You know, it just becomes easier like that. But technically, they can file it online by themselves, just like you can form entities online by yourself.
And there's a fee for
FinCEN does not charge any money to file it. No. Okay, we charge $50 per entity. Okay, this is what I was talking about before, and this is very important. Dissolving your entity does not exempt you. So if your entity existed January 1st, 2024, even if you dissolved it, you still have to file a report. If you formed it in 2024 and they were dissolved before the 90-day filing deadline, you still need to file. Okay, updates, if you have a new DBA, new beneficial owner, let's say somebody joined your LLC or somebody died, you need to update your BOI within 30 days. If something's inaccurate, you have 30 days to change it. And if something becomes newly exempt, let's say business is good, you become a large operating company, then you have to update FinCEN that your company is now exempt. Penalties, up to $500 a day, up to $10,000, plus 2 years in jail. The government is taking this very seriously. Penalties are stiff, so it's really not worth playing around with this stuff. Okay, the rest I'm going to skip because there was a ruling in an Alabama court saying that it's unconstitutional, but that's really irrelevant. And there's been another ruling since then saying that it's not, that it is constitutional, and this will be appealed in the Court of Appeals. In any event, it's not relevant for this year, so everybody needs to file, and no court is going to save them. I think that's basically it. Okay, if you guys have any questions.
Okay, so wait a second. So before we're going to jump now to open Q&A, but first of all, thank you. This was very professional and very comprehensive, and appreciate it. You're an excellent communicator.
Thank you.
Everybody, this has been recorded. We'll share a recording with all of you that registered, and now we're going to do open Q&A. So if you don't mind, at least
let's
now
jump back to the first question. The guardian. There's 5 exemptions. One of them is a guardian. A guardian is not a beneficial owner. It doesn't have to file. The person behind them does.
Okay.
Don't they get all this information from your tax, K-1s, tax returns? What if you're filing taxes, what's the benefit for them?
They'd like to know, your taxes don't indicate that you're a 25% owner. They don't indicate that you're a decision maker. They indicate that you made money. That's it.
Does that mean C Corps that are filing, people are creating it to minimize their income? There's no more hiding behind that shield?
You can still, there's no effect on taxes, but it has an effect on their anonymity. I mean, you're going to have to just tell the government that you own the corporation.
Okay, someone just posted a question. What a corporation that has an officer that passed away?
You need to update the BOI and tell the government that the person is no longer a beneficial owner of the company.
Got it. Okay. Looks like we've exhausted most of the questions here. Just to summarize it here, bottom line is that this BOI filing is as we've learned here today, is a one-time filing that you have to do with sometimes with some you have to do the updates as they come. It's technically a free filing. There's a link. You could do it online yourself. It's a little complicated, and you could pay companies like NUCO, who gave today's webinar. They take $50 and they'll do the filing for you. And if anyone that has a company has to do it, in other words, if you listen to this, some of these scenarios are very very specific. But if you own a company, at the end of the day, you know, even if it's a simple company and it's just you still have to do that filing. That's why it applies to everybody. And you know, the government has just decided that that this is something that they care deeply about. And so, even if you're a tiny little company, one person, and you're just doing your thing, it's something you got to do. And if you do it right and you do it once, you don't have to ever think about it again.
Your driver's license can expire, and then you would have to update that, or you can move your personal residence and you would have to update that.
Right. Okay. And some people asked if they wanted to contact NUCO to find out about your services. How would they do that?
There's a slide here. Let's see. I have a phone number, an email address. They can find me on LinkedIn. Let me just share this window, and then everybody could jot it down if they like.
Will we be sent the slide afterwards?
Sure.
Yes, again,
slides,
this whole,
yeah.
Okay. Right, okay. So if you want the slide deck, you just email Tzvi. The recording of today's class, again, is going to be shared with everybody that registered for this. They'll get an email tomorrow or the day after, so you could watch this. And okay, so thank you very much. This was very informational and very, very important. And thank you, Tzvi.
My
thank
pleasure.
you to NUCO. Everyone have a wonderful rest of your week. A Gomar Chasima Tova, easy fast, and God willing, November time, we'll have our next webinar. We'll keep you posted. Good bench to your all the best.
Thank you.
Thank you.